All right, let's dive into the very heart of the banking world, credit risk. It's this fundamental challenge that's shaped finance for, thousands of years. And really, understanding it is the key to figuring out how our entire economy ticks. So, to wrap our heads around this, let's start with something we can all relate to. Imagine you lend a bit of cash to 10 of your friends. Now, most of them, say 8 of them, are great. They pay you back right on time. One is kind of flaky and pays you back late. And then there's that one friend, the one who just ghosted you. Poof, money's gone. Well, congratulations, you've just had your first lesson in credit risk. Now, it's only natural that before you even think about lending money again, you're going to be a little more careful, right? You'll start asking questions. Who's got a steady job? Who's been reliable before? That simple thought process, that's credit risk management in a nutshell. But here's the wild part. How do banks take that exact same logic and apply it to millions and millions of customers? Okay, let's get official for a second. The top global regulators, the Basel Committee, they define credit risk like this. It's simply the chance that someone who owes the bank money won't pay it back like they promised. You have to remember, for most banks, their biggest asset is their loans. So that makes this, by far, the single biggest risk they have to deal with. So if lending money is basically making a bet on an uncertain future, how on earth do banks manage it? Well, they do it by trying to measure the unmeasurable. They've built this incredibly sophisticated system to try and put a hard number on the chances of not getting their money back. And you know what? This entire massive, complex world of credit risk, it really just boils down to answering two core questions. First, what are the odds that this person or this company is going to fail to pay us back? And second, okay, if they do fail, how much of our money is actually gone forever? Every single model, every system, it's all built to find the answers to just these two things. And to answer those questions, the industry has its own special language, and it's built around 3 key acronyms. These are the absolute building blocks of how banks think about risk today: PD, LGD, and EAD. So let's get to know them. First up, you've got PD, which stands for probability of default. Think of it like a percentage, a number from 0 to 100 that estimates the chance of someone defaulting in a specific time frame, usually a year. To get this number, banks throw everything they have at it: credit scores, financial statements, you name it, all to figure out this one single probability. Next is LGD, or loss given default. Now, this is a really important point. Just because someone defaults doesn't mean the bank loses all the money, right? If someone defaults on a mortgage, the bank can sell the house to get some of its money back. LGD is the percentage of the loan that's still lost even after they've done everything they can to recover the cash, like selling off collateral. And finally, there's EAD, or exposure at default. This one's pretty simple. It's the total amount of money the bank has on the line at the exact moment things go south. For a regular loan, it's just the amount left to pay. But think about a credit card. The EAD might be the entire credit limit, because someone in trouble is probably going to max it out right before they default. It's the total exposure. And now, this is where the magic happens. Banks take these 3 numbers, the probability of default, the percentage they'll lose, and the total amount they're exposed to, and they multiply them all together. The result is something they call expected loss. It's one single, incredibly powerful number. The big takeaway here is that banks aren't just guessing. They use a precise formula to turn all that uncertainty into a manageable number that helps them decide everything. Okay, so we've got the math down, but how do banks actually use this stuff in the real world? Well, it's not just about a one-time calculation. It's about a whole system, a continuous process of control that runs through the entire life of a loan. You can see that process laid out here across the loan's whole life cycle. See, managing risk isn't a one-and-done deal. It starts when the loan is first created or originated. It gets really intense during underwriting. That's where all the risk math happens. But, and this is crucial, it keeps going long after the money's out the door. The monitoring phase is constant, with banks always watching for the tiniest signs of trouble. And this whole system, it doesn't just exist in a vacuum. It operates under a really strict set of global rules, mostly from the Basel Committee. They kind of give banks 2 paths. Smaller banks might use a standardized approach where the regulator just tells them how to weigh the risk. But the bigger, more sophisticated banks, they get to use their own internal models, that PD, LGD, and EAD stuff we just talked about. Either way, the goal is exactly the same. Figure out how much cash the bank needs to keep on hand as a safety buffer. So far, we've really been zoomed in, looking at the risk of just one single loan. But now we need to pull the camera way back.
because banks don't have one loan, they have millions. And managing the risk of that whole collection, the portfolio, is a totally different ballgame.
Looking at one loan tells you about one borrower, but portfolio risk is all about how those loans behave together. And the total risk is not just adding up all the little risks. It's way more complex. It's all driven by these two powerful forces: concentration, which is having too many similar loans, and correlation, the scary tendency for different loans to all go bad at the same time. Concentration risk is just a fancy way of saying you've put too many eggs in one basket. Just imagine a bank that has almost all of its loans tied to real estate in one single city. I mean, what happens if that city's property market crashes? It doesn't matter how good each individual borrower seemed, one big economic shock can cause a massive wave of defaults all at once. So what's the powerful solution to this huge problem? Well, it's actually a concept we all kind of get instinctively: diversification. It's about spreading your bets. By spreading loans across different industries, different places, and different types of people, banks make sure that a big problem in one area doesn't take down the entire company. It's the exact same reason you wouldn't lend all your money to just one group of friends. So, okay, we've got the metrics, the process, the portfolio strategy, but let's take a step back and ask the big question. Why is getting all of this right so incredibly important? Because the stakes here are way, way higher than just one bank's profits. I mean, you don't have to take my word for it. This quote from the Basel Committee, the world's top banking supervisor, says everything you need to know. History has shown us again and again that the biggest financial meltdowns almost always start with failures in credit risk management, banks getting sloppy with their lending or just failing to manage their portfolios. And that right there is the most crucial thing to remember. This isn't just some internal issue for bankers to worry about. When banks get credit risk right, they basically act as the shock absorbers for the whole economy. But when they get it wrong, they don't just absorb the shock, they become the shock, and the fallout can affect every single one of us. Which leaves us with one final, fascinating puzzle. We've just walked through this whole system of metrics and rules and processes, and it all seems so logical, so well-defined. So if we have the blueprint, why, after centuries of trying, does getting this right still remain the single greatest, most difficult challenge in all of banking? Something to chew on. Thanks for watching.